It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda, Amin. Here are the top stories. Caution in the markets with focus on next week's BOJ and Fed meetings as investors await more U.S. price data. Indian markets on watch after a small-cap sell-off brought the worst day in 2 years for the country's stocks. The regulator raising concerns about froth in some sectors. Also ahead, the fate of TikTok, an app used by 170 million Americans, is now in the hands of 100 senators. We discuss whether the push to ban it will be a major flashpoint between Beijing and Washington. And to discuss it all, we have a great lineup of guests. Gene Master, co-founder of Deepwater Asset Management, and Thomas Tor from BlackRock will be joining us very shortly. And later on, we'll have Bernstein senior analyst with his call on India's financial market. Now, let's do a check on how markets are faring. Avril Hong here in Singapore with me. And Avril, you get a sense that there is trepidation ahead of that humongous week ahead.
Yeah, it's all about the central banks next week. The Federal Reserve will get their dot plots. That could inform the amount of easing we're going to get from the US Fed, but also the BOJ. So ahead of all that, and of course those retail sales and the PPI numbers out of the US to get through later today, you can see there's not much appetite for risk in the equity space, particularly on the BOJ front. Of course, we're watching very closely those wage negotiations. So far, they've come in strong. Workers have gotten those wage hikes that they want, but the Rengo tomorrow, that's a big one to watch. We also had some dovish comments, right, from the BOJ Governor Ueda, and that seemed to curtail some of the expectations of an imminent move from the BOJ and cap the gains on the yen. But as you know, we're seeing not that much appetite for equities. Now, that is what we're seeing broad picture, but let's zoom in also on what we're seeing in China, because we got some of those declines among the tech names. Those are the biggest drags today, but helping to support the CSI 300 is the gains on those copper-related stocks as the commodity surges. Remember, we're hearing those reports about how copper producers are mulling production cuts. Has.
And what a rally it is for those copper stocks. The other way as well is India. Avril, I mean, we saw that stunning sell-off in small caps. I mean, we knew it was hot, but few expected the sell-off.
Yeah, it was very hot. If you take a look at how it's run up since March last year, it's had a phenomenal time. And we saw the small and the mid-cap gauges for the BSE slumping more than 4% yesterday. This was their biggest decline in about 2 years. So with all this froth in the market, you can imagine why the regulators are flagging that overheating. They're telling money managers to limit their purchase. And given how a lot of this run-up has been because of retail participation, as sentiment turns, the concern here is really that it could drag the broader markets. We saw the Sensex down more than 1% yesterday, erasing the gains for the month, Has.
Avril, it's hot, hot, hot. Is the stellar equity rally in India finally cracking, or is this a buying opportunity? Let's bring in Thomas Tor, head of APAC iShares investment strategy at BlackRock. Tom, what's your take? Is it nerves?
Morning. Well, I think there's clearly a disparity going on between small caps, which have had such a huge run over the last year or so, versus the large caps. You know, in the Chinese New Year outlook that we did recently, we actually pulled India back to neutral just on some concerns around valuations and also some of the drivers around retail investing. But I still think, you know, India long-term, good structural story. You know, it can't go up parabolically forever. So I think, you know, maybe we need a little bit of a reset here. But I think still structurally, the growth story, the demographic story in India is very interesting. So I do think, you know, foreign investors will be continuing to buy Indian equities. We've actually seen quite a bit of outflow year to date in Indian equities. And for us, actually, at the moment, we're looking more at India bonds than equities at this point.
Tom, it's not just growth, it's 8% growth. So given the sell-off that we're seeing, should you be buying the dip or wait a little longer? There'll be more correction to come.
Well, I think it depends, obviously, on your investment outlook. Most of our investors are very long-term holders. I think we could see a correction given where valuations are, but it's not that dissimilar to a lot of markets we're seeing at the moment. Valuations are getting stretched. As you said, 8% growth in India is very, very appealing. The long-term structural drivers look very interesting, and also the earnings growth there has been very strong. So I do think any decent-sized correction, foreign investors will be moving back into that market.
You talked about liking Indian bonds right now. What are you liking? What should you be picking up?
7%. That's what I'm liking on the Indian government bonds. I mean, number one, yeah, it's pretty simple. I mean, you're getting very good yield there. We've got this new inclusion process into JP Morgan EM index. Foreign investors are very underway, and also in terms of correlations with other bond markets and equities, it does give good diversification in the portfolio. So a couple things: underowned, very strong yield, and diversification play. So I think there's a lot to like there.
Overall, the market's looking to the Fed and what's expected from the Fed and the messaging next week. How are you anticipating? What are you anticipating? What are you hoping to hear?
Well, it does seem that, given some of the inflation data we've seen just this week, there is a pretty strong potential of the dot plot being moved to 2 rate cuts for this year. So 3 to 2, what kind of impact will that have? Obviously the Fed is not expected to cut at this particular time, but they will give some indication as to forward the forward look on their dot plot and what the individual members expect. So if we move to 2, then clearly that will have a little bit of an impact on markets. US dollar, I think, will strengthen a little bit on the back of that. But as it is, we've already gone from 6 to 3, so 3 to 2. How much impact that will have, I'm not exactly sure. As I've been saying all year, I think the outlook now is more around volatility on equities and growth. What's the actual impact, drawdown impact on growth, both from GDP and also from earnings versus rates and inflation and volatility that we had last year. So that's kind of how I'm looking over the next couple of months.
Are investors reassessing risk, Tom? Because when you take a look at gold, which traditionally is a haven play, it is at record highs. It is higher than what the dollar suggests it should be. How are you looking at risk right now?
Yeah, I mean, there's a lot of disparities going on in the market, right? On the one hand, you see global growth slowing, decelerating, exports coming down, inflation still a little bit sticky, and on the other hand, you have these kind of pockets which continue to move up. Mega Cap 7 obviously is the big one, but India, as we mentioned earlier, Bitcoin, gold. Gold is interesting. I mean, gold is something that we like along with commodities as kind of a safe haven play. If you look at the disparity between central bank buying of gold and ETF buying, there's a huge gap there. So I think at some point ETF investors will actually come back into gold markets. But I've liked gold all year, and I continue to like it into the future because there are risks in the market, and I think investors need to have a very diversified playbook at this moment.
If there is one rotation to make, what would that be, Tom?
Well, it's obviously very hard to call, but in terms of the mega cap U.S. equities, we are talking about rotation there. We're not saying get out of U.S. equities, but I think certainly there is a case to take some rotation in those markets into some of the lower beta exposures or equal weighted type of exposures. I think if you look at the earnings growth has been very, very strong, but projected earnings growth for some of those companies or those 7 companies over the next year is around 30%. I think that's very optimistic. So I think particularly going into the second half of the year, of course, we have election risks. Will there be some kind of AI regulation? We don't really know, but I think now is the time to start looking at possibly rotating some of that portion of your portfolio away from some of those tech names.
Tom, hang tight. Thomas Tor, BlackRock is sticking around. Well, still to come, a deep dive into India's financial sector with Bernstein. It says it's time to switch out of public to private sector bank stocks. Plus, there's a battle raging in New Delhi over who invented an iconic dish. We'll dig deeper into the origins of the butter chicken later this hour. Keep it here with us. This is Bloomberg. Welcome back. The fate of an app used by 170 million Americans is now in the hands of 100 senators. A bill passed by the House of Representatives would ban TikTok in the U.S. unless ByteDance sells the video sharing app. The measure now faces an uncertain fate in the Senate. So what are the possible ramifications? Jean Monster is co-founder and managing partner at Deepwater Asset Management. Jean, good to have you with us. We know that it's late where you are. 352 versus 65. What are you reading into that vote?
You know, this is an 84% agreement from the members of the U.S. House, and that is unprecedented. It is so unprecedented, it almost reads like a typo. And to answer your question, what we should read into that is that there is clear political momentum to do something about TikTok in the U.S. And as you mentioned, is that the Senate, it now goes to the Senate. It has been referred to as an uphill battle in the Senate, an uphill in part because it's probably going to take somewhere between 2 and 3 months before the Senate actually takes a vote, if they do take a vote on this. As far as how that will play out, it's undetermined. I actually believe, just given the momentum coming out of the House, that this could get through the Senate. And if I may just keep playing this forward, if in fact that does happen, then, of course, it goes to President Biden's desk, and therefore it would likely get signed into action. But any good thriller, of course, does have a hanger here, and the hanger is the but, and that is related to what happens with the next presidential election. And so if, again, we keep playing this forward, if the next president is Trump, he would likely do what he can to reverse all that happens. And that gets us back to this point where I'll kind of bring this together with what my probabilities are. I think that there's a 25% chance that TikTok gets banned in the US, 25% chance a divestiture is forced, and a 50% chance that nothing happens.
That's a high chance of nothing happening. Jean, I'm just wondering, if it does get sold, who are the potential buyers?
Well, it's a pretty short list. So let's first talk about what the valuation would be. Is if you use a similar revenue multiple that Meta trades at, that's about 7 times revenue, and then you look at TikTok's U.S. business, that implies a valuation of about $100 billion. And so that's real money. There is considerations around which companies can get that money together. Those companies, Activision's former CEO is talked about putting together a group. I think he has enough strength to do that. Of course, the focus on Meta, that probably won't happen just because of regulatory. And then there is could be other corporate buyers too. I mean, the irony here is that the original potential buyer of TikTok in the U.S., this is 4 years ago, was Walmart. Walmart was the original one interested in this, and then that got blocked through some of Trump's actions at the time. And so it's going to have to be obviously a bigger buyer. It doesn't have to have issues related to regulation, and it's probably around that $100 billion valuation. And if I'm ByteDance, and there is a threat of divestiture or get banned, I probably take the $100 million and run.
Jean, we know that China will be up in arms, no doubt. I'm just wondering your take on it. Should TikTok be banned?
Wow, this is one I want to respectfully pass on. I can say that I can just maybe speak for one piece of the conversation related to TikTok, the impact on teens and the youth. Instagram in the U.S., the average time spent is per day. Instagram is about 40 minutes, and it's about 70 minutes for TikTok. I mean, these products are highly addictive. And so from my perspective, I'll just step outside of the geopolitical ping pong match related to this and just say that I think that there needs to be better curbs in terms of some of the usage here. And again, I think that this ultimately does get through the Senate.
ByteDance likely to challenge this, right, on legal grounds. What challenges do you think it will face, Gene?
So in the Senate, the reason why this has been referred to as an uphill battle, despite all the momentum coming out of the House, is that the senators are looking at this more of what is the government's role in terms of regulating business more broadly. And of course, the state of Montana has tried to put effectively a ban, and that was overturned in the courts. So there has been some precedents that essentially this is meddling in an area where lawmakers should not. It's just not the Senate's job. There's other means, other governing bodies to regulate business. And so I think that that's probably the piece. And then within that, of course, comes to free speech. So there's the side of the free speech piece, which would likely stand up. There's the side of the national security piece to the TikTok conversation. And that's where I think that this ultimately would get grind through the courts, is that the supporters of this bill, it's about the national security side.
Gene, we appreciate you being with us today. Gene Monster, Deepwater Asset Management. Thank you so much for that. Let's bring back Thomas Tor, head of APAC iShares investment strategy at BlackRock, for his take. Tom, I mean, just when Chinese tech stocks are beginning to rebound, I mean, how are you making sense of what's happening and the impact of it?
I was panicking a bit there because I thought you were going to ask me about TikTok, and I don't actually have that app. But in terms of the view on China tech, again, for us, the preference, if investors do want to be in China at this point, is for China offshore, China tech. And the reason for that is because the short interest has been so high. And actually what we saw last month in February was the first time since July of last year foreign investors had actually moved back into China. Coming up with a view around Chinese equities is obviously very difficult. There's a lot of upside risk, there's a lot of downside risk. But I think for us, what we're talking to clients about is if you want to play this tactical rally that we're seeing at the moment, and I think can continue, you do want to be more in the offshore space, in the super liquid type of ETFs where you can kind of play that rotation quite tactically. So I think for now, most investors would still be neutral, but given the amount of selling we've seen over the last few years, there is a lot of underweight in the market and a lot of short interest, which I think is starting to get covered at the moment.
The thing is, Tom, tech, telecom have pretty much led the rally. CSI up 13% from that low that we saw in February. I mean, what do we do with tech now? Just sit on the sidelines, wait for clarity before maybe do a play on it again?
Well, I think that's what has been happening, and over the last month, as I said, investors have moved back marginally. I think a little bit of it is a rotation away from India back into China, but I think a lot of it is really just given the risks to the upside and the risks to the downside. Investors don't want to be too massively underweight at this point, particularly with what's happening in the U.S. and then going into elections and all these kind of things that are happening in the market. I think investors want to sort of cover some of those shorts and be relatively neutral. I'm not seeing a lot of investors going massively long China at this point, but I think, given what's happened the last few years and the valuations and all these kind of things, I think being underweight is becoming a little bit more of a risk.
You've referenced the election several times now. How big a political risk is that for the markets? The
answer is I don't really know. But, what I do know is, 4 years ago, that's all anyone was talking about, and markets were starting to prepare for volatility, and we saw rotations into different sectors and that kind of thing, and healthcare was a big a part of that. And this year, I haven't really seen anyone particularly talking about it from a asset allocation perspective. Again, I'm not an expert, but if Trump does get back into office, then you will start to see these geopolitical tensions start to flare up again, and the talks about tariffs increasing and what that will mean for Asian economies, I think will increase. But again, I'm not a politics expert, but I certainly see that in the second half of the year, more focus going into that.
Appreciate that view, Tom. Now, Japan, I mean, how much upside can there be for the Nikkei 225? We're seeing the yen strengthening and some expecting the yen to strengthen further. That may put a lid on where it goes from here.
Yeah, I mean, I expect the JPY to strengthen further. I've been saying that since we were at 150, which is basically, it's not a particularly complex formula, but, the Fed, whether it's going to be 2, 3, 5, 4 rate cuts, the Fed are going to be cutting rates. Pretty much every other economy in Asia is going to be cutting rates, and the BOJ are going to be raising rates, whether that's next week or in April or in June. And given the mass depreciation that we saw in JPY, and when we start to see that carry trade really narrow, I think investors will start to buy JPY again, and that's why we've been talking about, look, I think if you look at investing in Japan into phases, I think phase one, we're kind of getting to the end of that now, which is investors were underweight for many, many years. We saw a lot of structural reforms coming through. Foreign investors have moved back in. Phase two is about, can you buy Japan in JPY? Can you buy active funds? Can you buy certain sectors? And phase two is really, I think, going to have to be driven more by that $7 trillion that's sitting in currency and cash deposits in Japan. So I think it's got to be more of a domestically driven story. And I think if we do start to see pullbacks, I think foreign investors will continue to buy it because, in terms of the index weighting, it's going to continue to go up. So for passive investors, they're actually going to need to continue buying Japanese equities. But I think that phase one is kind of coming to the end. And I think, now we look at phase two.
Tom, great to get your thoughts today. Thomas Tor, BlackRock, thank you so much for your insights. Let's do a check on copper miners on the back of the rally which we saw overnight, also on expectations that perhaps China may be putting a lid on its output among Chinese smelters. We have MMG up more than 7% gains too for the other players in Asia, including Jiangxi Copper, currently up by about 7%. Plenty more ahead. Keep it here with us. This is Bloomberg. Now, Apple's main iPhone maker, Hanhai, is reporting fourth quarter earnings later Thursday. The company is on track to report its second straight quarter of strong profit growth due to rising demand for AI hardware. Growth in that segment will probably offset weakness in iPhone demand, particularly in China. Apple earlier said this month sales in China fell by 24% over the first 6 weeks of this year. Let's do a check on how Hanhai is shaping up ahead of those earnings numbers. Foxconn also in focus. Hanhai pretty much unchanged. Foxconn down about 6.5%. That industrial falling about after that quarter earnings was amiss. It is weighing on that stock. We're also keeping an eye on Korean shipbuilders rallying as much as 16%. That's on the back of President Joe Biden pledging to review China's industry subsidies. We have Hyundai Heavy jumping as much as 11%, currently up, well, slightly more than that. Also gains for Hyundai Mipo Dockyard, currently higher by more than 5%. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. China markets just heading to lunch, and you know what? It is hard to sustain recent gains. CSI 300 index under pressure, down about 0.1%. We had Country Garden missing that payment. We had Vanke downgraded to junk. Property market concerns still at the forefront. Keep a watch on MLF tomorrow set to stay pet, but if there is a cut, no matter how small, it could just provide that much needed boost. CSI 300 index, as we said, in negative territory. Let's flip the page, take a look where we are in terms of Japan. It is coming back from lunch. Big week for the BOJ next week. Avril Hong is here with more. Avril.
Yeah, Has. I mean, it's really a matter of will it or won't it move next week, isn't it? And that imminent move seems to be what markets are betting on, especially as we get, those wage negotiations this week. They've been coming in strong yesterday. We'll have to get through Rengo tomorrow. Local media reports also spurring speculation. And then today, we get this report about how BOJ officials are mulling scrapping ETF purchases if their inflation target is met. So all in, that seems to be causing that move in the market. But think about it as well. We got those dovish comments from the BOJ governor just yesterday. Wants more comprehensive data. And the mixed signals, I think, shows us how the BOJ maybe has a communications issue ahead of it in the meeting next week. And why would investors take that risk ahead of all that? So that's why we're seeing the pressure on the Nikkei today, and that's playing out among tech shares as well, tracking what we're seeing globally and what we saw in the US overnight, and indeed in China as well. But helping to cap some of the losses, we're seeing the copper mining related stocks jumping along with their Asia peers as the price of the commodities surges. It's really about how China smelters are said to be mulling those production cuts. Let's flip the board and take you to cross asset in Japan. Just very quickly as well, we're seeing the yen gains reversed, probably because of those dovish comments from the BOJ governor. And don't forget, we have a 20-year auction to get through shortly. So bonds coming under pressure in Japan as well. Has.
All right, Avril, thank you. You're talking about the yen. It is struggling to hold its ground against the USD as momentum fades after a strong US CPI highlighted risks for the Fed next week. Let's dive into the latest signals for the BOJ with our MLive strategist, Mark Cranfield. Mark, of course, we have not just the yen, the JGBs, but treasuries all waiting in a way for communication from the Fed, from the BOJ. But this is a BOJ that's been pretty misleading.
There have been a few slip-ups in the past from the BOJ. The most recent one was in October. The new relatively new governor, as he was, Mr. Ueda, said that he didn't think it was necessary for the market to go to 1% for JGB yields. So, of course, the traders took it as a challenge and they drove yields exactly in that direction. So he has to be very careful what he says, especially during the press conference next week. So the statement itself will contain some information, but traders will be watching very closely the forward guidance that he provides in the press conference, and how he delivers it will help the market go in a certain direction.
Avril touched on the 20-year auction. I mean, this is a part of the market that's pretty much unloved. What are we expecting?
Well, it's going to be a tricky one, because not only because the BOJ is so close, but the last one was almost a perfect auction. We had a very big bid cover, very tight tail, all of the ingredients that would tell you that it was a very solid auction. That was just a month ago. Conditions have changed so much. And now you've got a situation where especially Japanese life insurers, who tend to like the slightly longer, they prefer 30 and 40 year, but they may go for some of these 20 years, but the absolute yield looks a little bit low. So this is going to be a very tricky auction.
Should we be concerned that the market has been so orderly? It's almost like the market's bracing for perfection, yet there are risks out there. I mean, how do we look at this?
Yeah, and it's not just the Japanese bonds, it's the whole G10 complex, even treasuries. We've seen before that when there have been wobbles in the Japanese market, when it's become a little bit disorderly there, it just spreads to the rest of the G10 world. And treasuries have been relatively calm just recently. So it wouldn't take much if we get miscommunications, people are not quite sure what the BOJ really wants next week, and the outlook looks a little bit murky. We could easily see a tailspin there, and it just spreads across the whole G10 world.
Give us insights on the possible winners and losers. KKR weighed in saying, you know what, the pivot by the BOJ would be good for real estate, for instance.
That's been a sector which has been ignored for a very long time. I mean, how often have we seen stories saying that New York, London, Sydney, Tokyo, not so much Tokyo, but Singapore and Hong Kong have been places, and Japan gets left behind. Finally is coming back into the picture, and a big name like that will obviously support it. But also financials, of course, Japanese financials, they like it when the Japanese yield curve goes higher. They can charge more to their clients, bigger margins. So they're an obvious winner. The insurance companies as well, for a long time, have struggled to make returns in Japan. They will surely enjoy higher rates. On the flip side, Maybe someone that won't be quite so happy is anybody in the tourism sector, because if the yen does strengthen, maybe not quite so many tourists coming to Japan.
All right, Mark, thank you so much for that. Of course, real estate, a good hedge against inflation. MLive strategist Mark Cranfield, we thank you so much for your insights. Now to Chinese markets and a bull rally in tech stocks fueling a debate over whether we're finally seeing a bottom. For more, let's bring in Bloomberg Intelligence senior analyst Robert Lee. Rob, is the rally in China tech at risk given the latest news on TikTok?
Okay, good question. I think, any rally we're seeing in Chinese stocks at the moment, it really reflects the very low expectations and the relative underperformance of the China market versus most over markets globally, and certainly versus NASDAQ. So I think that's more domestically focused and domestically driven. Whereas the TikTok news that's making the headlines today is more about the overseas operation of ByteDance, which is still a major Chinese corporation, but the uncertainty there reflects their overseas and US operations only. So I think the read across to China itself is fairly limited.
If you had to make a bet, pick a winner, would that be Baidu? I mean, we saw how the Chinese premier made a visit to its office in Beijing. Is that a good sign?
I think it's a potential endorsement and recognition of their position as a leading Chinese AI company. But based on our fundamental analysis, their AI business is losing money and will remain loss-making through this year. So whilst it's nice to have a very senior politician recognise the strength of their IP, from our point of view, are they going to monetize that, and at what point are they going to drive into profit? And based on our numbers and our analysis, we don't see that happening on a reasonable time frame. So I'm afraid, whilst I'd love to give a positive answer there, I think Baidu is going to continue to struggle operationally.
So which ones might do well, Rob? Sorry to put you on the spot right now, but which Chinese tech companies might just do well?
Okay, it's all relative. So I think there are very few Chinese tech companies out there that can match the sort of growth projections of the Magnificent Seven. But I think on a relative basis, and also factoring in the much lower market expectations and market valuations, then really a company like Tencent. Tencent is a relatively broadly spread business, which has a degree of defensiveness across its business operations, in contrast to the likes of Alibaba, whose business is really being undercut by low-cost rivals. Tencent's a business that can grow its earnings and free cash flow, easily in the 10 to 15% range over the next 2 to 3 years. So I think the question for investors is, that's a relatively solid outlook for a very large tech business. Is that truly reflected in the market price and market expectations? And we've recently added it to our focus list as an idea on that front. So we think there's a mismatch in expectations there.
And Rob, we're awaiting earnings from Hanhai. This is against a backdrop of the weakness in China for Apple. I'm just wondering, how much of an impact might that have on Hanhai's numbers?
Yeah, absolutely. It's all about Apple, because Apple accounts for over half their revenues. So in brief, the company will report weak numbers for 2023, but that's known and arguably priced in. 2023 was weak for them because of destocking in the mainstream smartphone and PC market, but that's played through and that's known. Going into this year, it's a much better outlook across their core markets as growth resumes. However, this Apple overhang and Apple uncertainty is going to impact them. So we did see reports a couple of weeks ago about Apple's smartphone shipments in China being down something like 24% in the first 6 weeks of the year. It remains to be seen, well, first of all, is that true? Because it's a rumour, or speculated, I should say. Secondly, if we are seeing continued weakness on the Apple front, to what extent will that impact Hanhai over the coming year? I think the longer-term outlook on Hanhai does look more interesting as the company diversifies into EVs and also tries to vertically integrate into components, but those are longer-term drivers for it. The focus is all going to be on Apple.
Good stuff. Rob, thank you. Bloomberg Intelligence senior analyst Robert Lee joining us from Hong Kong. Well, coming up, Bernstein tells us why they think it's time to switch back to India's private sector bank stocks. More on the outlook coming up. This is Bloomberg.
I still think, India long-term, good structural story. It can't go up parabolically forever. So I think, maybe we need a little bit of a reset here. But I think still structurally, the growth story, the demographic story in India is very interesting. So I do think, foreign investors will be continuing to buy Indian equities. We've actually seen quite a bit of outflow year to date in Indian equities. And for us, actually, at the moment, we're looking more at India bonds than equities at this point.
BlackRock's APAC iShares investment strategy head Thomas Torr. Now, welcome back to Bloomberg Markets Asia. You're watching India Focus. Let's take a look at where India is shaping up in terms of its play today. 4 minutes to that trading day. We're seeing India continuing to be under a lot of pressure. Of course, we saw the correction just yesterday. Sensex index pointing to a lower open, down about 0.3%. Nifty futures down about 0.2%. Now, a correction in India's small cap stocks is souring risk appetite on the broader market. The index has lost over $40 billion in market value in less than 2 weeks after authorities flagged risks of overheating. Let's discuss this and more with Pranav Gundlapillai, senior analyst at Bernstein. Pranav, good to have you with us. How are you assessing the sell-off that we saw?
Hey, Haslinda. I think this was in a way overdue, because I think the mid caps and the small caps had run up a fair bit, with almost 50% of them trading over 40 XP. And I think the only thing which held off the sell-off previously was just a strong macro, which has prevented a sharp sell-off. But I think this is a normal correction, and just brings back the large caps and small caps to a similar range. I think they had run up a bit more than what the fundamentals required them to. So I think it's a healthy correction in that sense.
Right, but the correction is also driven by the clampdown we've seen from SEBI. Is that clampdown justified? Should it be expanded or not?
So I think it's more action to protect a whole set of new investors who've come in. So I think it's more from the perspective of protecting the new investors, plus ensuring that it doesn't create a ripple effect onto the broader markets as well. So I think it's more a proactive step that SEBI had done. And I think that was just a trigger that was required. Otherwise, the macro was preventing a major sell-off. And this was just a trigger for the correction that was anyway due to happen.
Are you looking at possible opportunities? What are you advising clients to do? Should they be looking at smaller private plays in terms of banks? What are you looking at in terms of opportunities?
We think the large caps is where things look most attractive. I think we've held that view since start of the year, that the larger names, especially in the banking sector, are looking a lot more attractive versus the smaller names. I think large cap banks, especially the large 3-4 private sector banks, is really where we would advise private, investors to be at this point in time.
And in terms of shadow lenders, are they an attractive investment? Recently, we've seen how SEBI clamped down on shadow banking. There are concerns in that particular sector.
I think there again, the concern from the regulator, both RBI and others, is around the new type of lending models that have emerged. An abnormal pace of growth in certain segments is what is coming under scanner. I think at an aggregate level, the credit growth has been fairly healthy in the sector. We are not concerned either the overall credit or even within consumer. I think at an aggregate level, we are still in a very, very healthy pace of growth, nothing excessive that we see. The clampdown, we think, is more a preemptive step to make sure that the due processes are being followed. There is no risky segments that are being onboarded. I don't see that as any indicator of the overall consumer lending segment in the country. So I think we remain positive on the consumers lending segments as well. But for NBFCs that have seen much faster than usual growth, I think there's probably some amount of a slowdown which is going to kick in as we go forward.
Might credit growth slow down or moderate given regulatory actions recently? Is that something we might expect?
Yes, on the consumer side, I think we definitely are expecting a slowdown in growth. I think that part has been communicated by the regulator, and also the actions being taken are driving the banks and NBFCs towards that. Right? So both the increase in risk weight, the clampdown on certain types of loans which were seen as unhealthy or growing too fast, will all result in a slowdown in consumer credit. So I think that is something that's already priced in. I think the overall banking credit also is probably a couple of percentage points higher than what most would have expected a year ago. And that has been largely led by consumer growth. I think that will moderate, but hopefully the commercial credit or the corporate credit will pick up, especially the capex cycle kicking in, to keep the overall credit growth still in that mid-teens range for the banking sector, banking as well as the NBFC sector.
You're saying that it is time to get back into India's private banks versus public banks. Within that sector, which ones would offer the best value?
To us, within the private sector banks, we like HDFC at this point in time, just given that the core of the franchise remains intact in terms of its deposit gathering ability, plus its stellar underwriting track record, coupled with valuations that are extremely attractive. HDFC remains a top pick. And I think there's a broader call for us, from us to shift from the public to the private sector banks. I think most, all the 3 or 4 large private sector banks look attractive at this point in time. Given that, there is the overall healthy credit growth plus reasonably benign operating environment, we think that the large private sector banks look attractive. Within that, HDFC is our top pick.
Before I let you go, Pranav, the big question in India right now is when the RBI will start cutting rates. I mean, what's your own assumption?
See, our assumption is we'll have a shallow rate cut somewhere towards the later part of this year, after the elections, maybe somewhere in the September to December period. But it should be a shallow rate cut, 25 basis points, which will not have a major impact on the banking margins.
Pranav, thank you so much for your time today. Pranav Gunlapillai of Bernstein with his insights on the Indian market and the clampdown that we've seen from SEBI as well as the RBI. Let's do a check on Indian markets. Been trading for about 3 minutes right now, under pressure. Continuing to be under pressure given what we saw yesterday. There's a lot of froth, they say, in the market, and we're seeing some consolidation. That consolidation persisting today. Sensex index currently down 0.3%. The other benchmarks also in negative territory. We continue to track the Indian rupee, 82.83 versus the USD. Now, still to come, we sink our teeth into a lawsuit over one of India's most famous dishes. The battle over butter chicken is next. Keep it here with us. This is Bloomberg. Well, Asia under pressure. It is a big week ahead. We have PPI on Thursday, triple witching on Friday, also the Fed next week, not to mention the BOJ. Talk about trepidation, talk about nerves, and it is reflected in the markets today. The Hang Seng currently down by 0.7%. The Nikkei also in negative territory. The Sensex extending the loss, which we saw yesterday, down 0.3%. The massive retreat in small caps in particular. We've been talking about froth and a hot market. Now sentiment is being impacted as well. Now let's stay with India. It is in the grips of a spicy court battle over, well, butter chicken. For weeks, 2 popular restaurants have been fighting it out in Delhi's High Court over who can call themselves the inventor of the dish, with neither side showing any sign of chickening out. India Court's reporter Shruti Mahajan joins us with all the juicy details. Shruti, good to have you with us. What is this fight about?
Thank you. This fight essentially is between 2 restaurants, both of whom claim that their chefs were the ones who invented this dish, butter chicken, which is popular world over. To be sure, this lawsuit was filed in January, and this month we are expecting a small development in procedural aspects in the court. But at the heart of this lawsuit is the claim that which restaurant actually has a claim over the tag of inventor of butter chicken. We have Moti Mahal Deluxe on one side, which was established post-partition back in the 1940s, whereas on the other hand we have a fairly new restaurant which was established in 2019. Moti Mahal wants Daryaganj, the newer restaurant, to stop claiming that that restaurant has legacy over butter chicken's invention. So this is exactly at the heart of the courtroom battle that we are seeing right now.
We know that food fights are pretty common. I mean, even Singapore and Malaysia fight over who actually is the inventor of chicken rice. But, you know, the big question really is, why did this fight make its way to the courts?
So my colleague Kai Schultz and I, when we were reporting on the story, what we discovered was people in Delhi are extremely passionate about their food. So any kind of legacy or reputation or goodwill that is associated with a restaurant, it goes a long way in bringing in business. So if one restaurant claims to be the inventor of butter chicken, and at the same time a contrary claim is made by another restaurant, it also poses a threat of business being lost at the hands of the other restaurant. So this is where the entire picture comes into place. We also have seen a lot of restaurants claiming that they have no other branches just so that they don't lose out customers who may be customers to restaurants who may be using false indicators of being branches of a popular restaurant. So legacy, reputation and goodwill, which brings in business, is basically at the heart of why these food fights happen.
Fascinating story. Shruti, thank you. India Courts reporter Shruti Mahajan in New Delhi. Watch the space and see how it plays out in the courts. Let's take you back to markets and see how markets are doing right now. We know that there's a lot of trepidation ahead of that big week. We're keeping tabs on copper miners in particular. What a run for them following their overseas peers high after copper surged to 11-month high. That's the potential of capacity cuts at China's smelters, and that's playing out in what we're seeing right now. Jiangxi Copper currently up by more than 5%. Jinchuan Group International also surging higher by almost 10% right now. Let's take a look where we are in terms of the broader market. Markets looking ahead to lots of data and meetings. PPR on Thursday, triple witching on Friday, and S&P, of course, keeping a watch on the Fed, and the Nikkei keeping a watch on the BOJ. Futures pointing to flat open, 52.37. We have two-year yields trending at 4.63 and the dollar at 12.29. Of course, we've been talking about that strong dollar impacting Asian currencies. Lots to digest in the coming week. And of course, here in Asia, it is pretty flat at this point in time, tilting towards negative territory. Take a look where we are in terms of the Nikkei 225. It is currently down about 0.1%. China also under pressure at down by about 0.1%. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Keep it here with us. This is Bloomberg.